Aloha and good morning. Welcome to Atlas Insurance Agency's AOAO webinar series presented by our AOAO Specialty Group. I'm your host, Sean Satterfield, Business Development Director with Atlas Insurance. Atlas has been in business since 1929, and we provide risk management and insurance services to Hawaii clients. We're the largest insurance agency in Hawaii, and Atlas has recently received the honorable distinction of being the only Hawaii-based company ranking in the top 100 independent property and casualty agencies in the United States. Today, we are challenged with a hardened market, and as a result, a rise in premiums. In a few moments, we will explore how our experts are handling the hardening AOAO market.
Take a live look right now over the New Haven Green. We're looking at cloudy skies over the
Before we hear our speakers, please allow me to go over a few housekeeping rules. The participants are in listen mode only, and we will do our best to address all the questions that are submitted at the end of our presentation, based on the time we have remaining. And please submit your questions through the chat. And you can start submitting your questions at any point during the presentation. I'm thrilled to hear from our guest speakers. We have an exciting agenda today, starting with two titans in their views of the global marketplace and how this ripple effect impacts our local Hawaii market. Next, we will hear expert insights on the state of the D&O market and give answers to why it's hardening, along with the challenges of the umbrella and excess markets. And finally, we will discuss proactive market strategies on how Atlas can be your guide. At the end of our presentation, we will conclude with question and answers. Our first speaker, Jim Sipich, is a seasoned veteran with over 30 years of industry experience. Jim is a senior vice president with CRC Insurance, and he is a leader for the West Coast Property Management Team. CRC insures over 284,000 properties that cover 237 markets and places over $1.4 billion in real estate premium. Jim, can you share some of the effects you've seen as a result of the hardening property market?
Sure, Sean, thank you for having me. I think it's so important to be prepared. We've been in this market for a little while now on the mainland, and I think it's wise to get an early start and have everyone be prepared. Just a quick word about my position on excess and surplus lines broker is basically a go-to for a independent agent like Atlas or others when they don't have any traditional markets to participate on a risk. We're seeing more and more of that, and the market is changing. We're definitely in a hard market. So what does that mean? Well, underwriters and carriers generally they're under less pressure to grow the top line. There's less capacity available, and by capacity, I'm meaning think of it as a unit of insurance, or in terms of supply and demand. There's just less insurance capital chasing new insurance opportunities out there. That's going to result in higher rates for everyone. That's going to result in higher deductibles because carriers want their insureds to accept more risk. That's going to mean underwriters are taking a little more time to look closer at the risk. It's going to mean putting together better submissions, more accurate information, and more detail if you want your risk looked at. And probably most important for Hawaii, it's going to mean underwriters and carriers are going to be forced to adhere to their natural catastrophe risk models, which is how they measure their aggregate exposure to earthquake or flood or wind or tsunami. Next slide, Sean. So I was asked, how does the mainland market differ from Hawaii? And I think I just listed off a lot of the reasons. It's unique, Hawaii, for many reasons, so many good reasons, but it's also unique because of the hurricane risk. tsunami risk. Nowhere else on the mainland would you ever find that combination of catastrophe perils. Thankfully, as my first bullet point there, you have some Asian-owned carriers that have really moderated the market in Hawaii. They've really brought in some stability. If we were to rely exclusively on traditional North American or European insurance carriers, they're much more conservative in how they handle their natural catastrophe risks. Next slide, Sean. Hawaii does lag behind the mainland insurance market, and we've definitely seen that in the last couple of years. Trends typically start in London. It's insurance centers of London, Bermuda, and New York, and work their way west. We've had many cases where the market didn't actually, it took too long. The market was very reactive, and it turned around before it even hit Hawaii. Really, in this case, on the mainland, we're facing, we've already been through 2 years of rate increases on many tough renewals. I think it's important to realize that Hawaii, though you may have seen some rate increases, we're really looking at a long stretch of what I would call soft market. You really haven't had to bear any difficult rate increases at this point. So this is something new, and I understand that. Next slide, please, Sean. So thankfully, we do have a lot of competition still. We do have some competition in the Hawaii marketplace for property insurance, but it's limited. As I mentioned, those Asian carriers, there's a few others. You're really limited to maybe 2 to 4 carriers on any one risk, and what you need to be scared about is what would happen if you didn't have those 2 standard markets, those 2 traditional markets. Then you get into my market, which is the excess and surplus lines, and then you get into underwriters who don't offer $40 million of limits, who don't offer $100 million on a high rise. They're underwriting instead to just a very small line, and it might be 10 carriers offering $10 million each in order to get it done, and that gets expensive. To move to the excess and surplus lines placement, I would expect at least a 50 to 100% increase in premium over what you're paying now. Next slide. So we're seeing that the property coverage is most impacted by the hard market. Really what you're seeing in Hawaii now is a sharing of the global loss experience. You're paying 10, 20% generally on average higher because everybody is sharing in the risk of global loss experience. I mean, you look at the news today and it hasn't gotten any better. We've got 2 hurricanes approaching Florida and the East Coast. We've got COVID losses, which do impact insurance, accumulating. We've got hail in the Midwest. We've got fires here in San Francisco, where I'm at. There's smoke outside now. It's just those are all adding up to a very tough property insurance market generally, and carriers are backing off, and there's very little new capacity chasing it. If you were a winery, for example, some of these in California, the market is withdrawn almost completely from that market. They're paying 200%, 300% of what they used to pay. Same goes for flood coverage in Houston because of loss experience. And What we don't want is for Hawaii to become one of those niches on the bad list. Right now, Hawaii is still a relatively desirable place for property insurance. You're very fortunate to have healthy competition. I guess in my world, 10 to 20% is a real hard market at this point. It could be worse. So I think that's the last slide, Sean.
Thank you, Jim.
Yeah, thank you guys.
As a friendly reminder, please submit your questions throughout the chat. Now we have the understanding of how the markets are affected globally. Let's now turn to Ron Tsukumaki to discuss Hawaii Marketplace. Ron is a consultant for Atlas's AOAO specialty unit. He's been leading the unit since 2007 and brings over 4 decades of experience. He works with our AOA group to manage over 300 condos and HOAs throughout the state of Hawaii. Ron, give us an idea of the local property market landscape and how carriers' appetites have changed.
Thanks, Sean. Aloha, everyone. So my job is to talk about the local marketplace. Well, Jim hit on a lot of the issues. And first of all, we're going to talk about the current market cycle. Jim was talking about the hardened cycle. But the insurance market goes in 2 cycles. One is I call the greed cycle, and that's when the market gets real soft because there's a lot of competition, a lot of money flowing into the market, which allows insurers to write more risk. And so Jim mentioned several years of soft market, and I call it the greed cycle because all these people are pumping money into the insurance industry so they can get that premium and invest it and hopefully make a profit on the losses. But that period has definitely ended. For Hawaii, I've gone through 3 market cycles, actually 2 on the mainland and then 1 major market cycle here in Hawaii. And that was going back to Hurricane Katrina. Surprisingly, we didn't have a big market cycle when Hurricane Iniki hit or Hurricane Eva hit back in the 80s and 90s because it was focused just on Hawaii. So we got past those fairly rapidly. There were some increases, certainly, for a short period of time. And then the market's hardened since, softened since 2008. So what are we looking at today? Well, Jim did mention there's some competition, but I have to tell you that competition, because we are a small marketplace, is very, very limited. I'll talk about, I basically break the market into fire resistive accounts and wood frame masonry joist accounts. Those are the main type of construction, and our markets sort of fall in each category. So for fire resistive, really there's 3 standard markets. Most of you have heard about First Insurance, Fireman's Fund, and recently, since 2006, DB Insurance. Those are the standard markets. Now, there are other markets in Hawaii, Island Insurance, Dietrich, and certainly those markets participate, but they are relatively small players, and their capacity has been relatively limited. Back in the, I say, old days, prior to Hurricane Iniki, there used to be State Farm in the marketplace. Well, you don't see them any longer. They can retain business that they've had, but they don't write any new business. So those are the 3 major fire resistive markets: First, Fireman's Fund, and DB. Wood frame, masonry joist. We have basically 3 competitive markets left in that arena. Lexington Insurance. That's a program written through Sweat and Crawford, or CRC, by the way. Lloyd's of London. There's a program written through another broker called RPS, and they have a program that's been in existence for several years in Hawaii. And lastly, DB Insurance. Of the three, DB is the only admitted market for wood frame masonry joists. Next slide. Okay, so let's talk about appetite changing. I'll start with First Insurance. They were the big player for many years. And what's happening? And for those of you who are written by First Insurance, you're going to notice things like reduced capacity. What does that mean? They are no longer offering the limits they used to offer. We have a very large condo association, well over, 300 million, and First wrote it for over 20 years. Well, this year they indicated that they can no longer write that much capacity. And so they are non-renewing because of the capacity. And the indications are 100 million capacity is what they're looking at. I think they are re-underwriting all their clients, looking at what they can put up or not put up, but they're certainly looking harder at condominium associations. In the fire resistive market, you'd think they'd have a lot of capacity, but they're looking hard at the risks, especially non-sprinklered older risks. What are they doing? They're certainly, for those the risks that they're staying on, they're going to increase their rates. You're going to see rate increases. Hopefully they'll stay at 20%, but we've seen some significantly higher if they've agreed to stay on. Okay, next slide, please. Okay, Fireman's Fund. I put a slash there. It's Fireman's Fund and Allianz. Allianz is one of the largest global insurance companies out of Europe, and they purchased Fireman's Fund a few years ago. Going back to something Jim mentioned, he talked about how conservative Eastern, mainland, and European underwriters are. Well, we're starting to see that conservatism hitting Fireman's Fund. They have a lot of capacity, no question. Allianz is one of the largest companies in the world, and they're bringing their capacity to Fireman's Fund. But because of that conservatism, they're closely reviewing accounts. And if your account has loss issues and is non-favorable loss issues, they are significantly changing their terms. They're increasing deductibles. We have seen $50,000 deductibles from Fireman's Fund. When the standard used to be $5,000 and then it went up to 10, now you're seeing it jump to 50, and the rates are going up. They haven't been writing oceanfront properties for the last few years, and so again, you're seeing a lot of change in underwriting. They're asking a lot more questions. Yeah, they have huge capacity when they want to use it, and they're very conservative about using it. Next slide. DB Insurance. They are probably now the most aggressive insurance carrier, and they, for the last year, have really increased their size of accounts that they wanted to pursue. At one time, they were pursuing accounts up to probably $120 to $140 million in size. Within the last year, they are pursuing much larger accounts. And so they've increased the size of accounts that they're writing, and they're still very aggressive. On the downside, they're also adverse to accounts with poor loss history. If you have poor loss history, they're going to be asking a lot of questions about what you're doing to prevent future losses. They're becoming much more selective with older accounts, such especially accounts that are over 30 years old. Those are the accounts that First and Fireman's Fund are having trouble with because of water damage claims, because of the pipes. So they are becoming more selective. And but they are still one of the most competitive local markets. Next slide. Okay, for wood frame standard, Lexington has been they're a big market. Lexington is an AIG company, so they're a member of one of the largest insurance groups. They are writing business here in Hawaii, but they've become much more selective over the past year. In talking with their regional underwriter, he mentioned that last year they had over $4 million of losses. A lot had to do with plumbing and water damage claims, and therefore they are increasing their rates and deductibles, but more so, they are really becoming much more selective. Next slide. Okay, the Lloyd's of London RPS program. Most of you don't know, but Lloyd's of London has really taken a brunt of the global catastrophes the last few years. And many of the Lloyd's of London syndicates have had a negative loss history. And so they have been shrinking very rapidly their capacity to write cat cover. And that catastrophic loss coverage basically for Hawaii is hurricane, flood, earthquake, and lava flow. But for most of us on the other islands, it's hurricane. So we've seen that shrinkage. And much like Lexington, DB in the wood frame market, they are becoming much more selective. Next slide. Okay, what's the ramifications of being non-renewed? Well, as I mentioned, there are certain reasons for non-renewals. First, insurance. If your account is over 100 million, then you could be non-renewed. If your loss history is good, yeah, then there are other markets that we can take you to and probably have a pretty competitive renewal. But those are only for accounts that have pretty good loss history. For those accounts that have been non-renewed due to adverse loss history, we're going to be talking to Jim Sipich and his group, because the excess and surplus lines market is really the only other choice. And as Jim talked about, it's not going to be a pretty choice. Next slide.
Thank you, Ron. That's great. Let's now turn to the D&O marketplace and what changes are on the horizon due to COVID-19 and other factors. To speak on the D&O market, we have Alex Moncler, a business development manager at Kevin Davis Insurance Services. Alex oversees the underwriting and marketing of the Southeast Territory of the United States. Kevin Davis provides coverage needs for over 40,000 community associations across the nation. Alex, please tell our audience about the state of the D&O marketplace and what impacts they can anticipate.
Awesome. Thanks, Sean, and thank you, Atlas, for allowing me to be here. So the first question is, what is the state of the D&O market in Hawaii? So from our perspective, the market is hardening and rates are on the rise due to three things: COVID-19, which I'm going to discuss in detail later, social inflation, and an increase in challenges to the board's authority to enforce documents. Next slide. So what is social inflation? Social inflation is one of the latest buzzwords in insurance. It is used by insurers to describe the rising costs of insurance claims caused by legislative, judicial, social, and economic developments, resulting in more litigation, broader definitions of liability, and larger jury awards. Interestingly, Travelers revealed that it is raising insurance prices and changing its litigation strategies in response to social inflation. There's been several societal and legal trends that have developed to increase companies' loss costs despite their best efforts to control them. It has driven up D&O liability claim frequency and severity to the degree that the rate increases can't keep pace with these losses. And from an insurer, it is hard to predict social inflation trends, making it difficult to underwrite and price risks. Today's social and economic climate is causing many to believe that corporations cannot be trusted. As a result, juries are increasingly likely to sympathize with the plaintiff when awarding damages because of their level of distrust, regardless of fault. This has caused verdicts to reach numbers that were never heard of before, impacting most liability coverages. I believe this has now impacted community associations in that as community associations become more diverse by their ethnicity, race, religion, age, and socioeconomic status, they are having to conquer a new set of challenges never before faced. And a failure to properly address these issues head-on could lead to serious issues involving libel, slander, discrimination, and/or harassment. The failure to act on these issues can prove very costly. A claim which I've displayed right now comes to mind involving a male resident who kept harassing a female owner, yelling racist and sexist remarks and threatening her. She repeatedly complained to the association. The board failed to act even though it was fully aware of the problem. She sued the association claiming that she suffered emotional injury and sought punitive damages. Once the association knew about the incidents, it had a duty to intervene. The association acted with reckless disregard of her rights. The board was ordered to purchase her home and pay damages. The total loss was over $1 million. So this individual harassment claim cost the association quite a bit of money. Many states, including California, where we're based, define harassment as unlawful violence, a credible threat of violence, or knowing and willful course of conduct directed at a specific person that seriously alarms, annoys, or harasses the person, and that serves no legitimate purpose. While this definition might change a little state to state, it mostly stays the same. For example, a resident who lives in a 55 HOA and over placed a Black Lives Matter sign in her bedroom window. She received a call from the HOA president asking them to take down the sign because the unit behind her is in the process of listing their unit for sale, and they think the sign could ruin their sale. The problem with societal issues that we want to ignore them and are unsure how to deal with the resident who harasses others. Some are fearful the individual will shift his attention and start attacking them. They hope the bad behavior will subside on its own, and it usually doesn't. And as I said before, the failure to act can be expensive. Next slide. So what do I mean by challenges to a board to enforce documents? As I said earlier, the board's exposure to liability losses has increased due to the awareness of individuals and how they should be treated. This has led to an increased enforcement challenges to the board based upon the rules are unfair, discriminatory, unreasonable, and unenforceable because the people who live there believe they know their rights and are treated unfairly. And often members of this group have never read the governing documents or attended a board meeting. An interesting enforcement situation involves the owner of an upstairs unit that installed hardwood floor that disturbed the tenants below so much that they moved out because they could not stand the noise. The owner is refusing to change the flooring or put down carpeting because of allergy concerns. The board wanted to amend their CC&Rs to prohibit hardwood floors. The problem was the board was unaware that if someone has severe allergies, you must reasonably accommodate their request for a hardwood floor. This creates two enforcement problems in that allowing the hardwood floors to be installed does not mean the person can destroy the quiet enjoyment of the resident below. The owner can keep the hardwood floors provided she gets a letter from her healthcare provider that the floors are necessary and she eliminates the noise in the unit below, either by installing hypoallergenic rugs throughout her unit or reinstall them with proper soundproofing material. Again, if the board fails to take appropriate action, it could result in a lawsuit against the association by the owner below for failure to enforce the documents. So I was posed the question, is Hawaii treated differently? Yes, a little. The incredible amount of litigation coming out of Hawaii makes for stricter underwriting guidelines and consistent thorough review. This is no different, however, than areas such as New York City and Southeast Florida. In less litigious states and areas, you might see an underwriter make exceptions. That's not the case in Hawaii. Next slide. So how has loss history impacted premiums? So it's no secret that loss history directly impacts premiums. Every single state has a rate increase need, i.e. increased premium. Hawaii is no exception with a 5-year loss ratio of over 100%. So what that means is for every dollar that comes in, we pay a little bit over $1 and change. The need to increase the rates is on par. Most community associations can expect that they will see a raise in their premium over the next year. Next slide. So has the pandemic put additional pressure on D&O rates? Yes, but let me expand on it since COVID-19 is such a massive concern right now to community associations. COVID-19 has created an incredible challenge to community association boards throughout the US. It is now their responsibility to close pools, gyms, and clubhouses, enforce the rules and regulations, and to ensure the community is making sound, responsive decisions with the health, safety, and welfare of its residents in mind. And the problem is that COVID-19 has left community association boards with many more unanswered questions than answered ones. Community associations do have the emergency powers to close the common areas. They also may need to close off entire condominium buildings and units to anyone or any unit owner or tenant. The problem is that after you close the pools and gym and informing all members that the reason is to protect their health, it's usually not enough. They constantly battle the boards by questioning their authority to restrict access to the association's common areas. So, next slide. Oh no, stay on the slide, excuse me. So just a few complaints that we've heard about. Failure to open pools, gyms, and other common area services. Failure to have full and unrestricted access to the facilities, for example, elevators, parking lots, and staircases. Failure to allow an essential guest from entering the association property. Failure to allow a vendor who has a current contract with the association on the property. And failure to allow short-term leasing. Claim filed for assessment reduction for loss of services. Wrongful foreclosure for delinquent assessments. Too many associations do open their facilities while the city, county, or state requires them to stay closed. If someone catches the virus and claims it occurred while the facilities were open, the association would not have any liability insurance coverage. Their general liability policy has an exclusion for communicable diseases, and the D&O has a very strong bodily injury, sickness, disease, and death exclusion under their policy. If boards open their facilities in compliance with health department guidelines and follow them, it can significantly lower the risk of lawsuits being filed against the association. If someone were to sue alleging they contracted the virus from the association's gym, swimming pool, or clubhouse, coverage would still be difficult to find, but the exposure has been reduced, but not eliminated. Next slide. So with a hardening market, we understand we may see additional exclusions added to the policy. Can I elaborate further? Absolutely. So as I mentioned this a bit before, from our perspective, you won't see additional new manuscript exclusions never before seen. Rather, you will see some carriers begin to decline to write associations they may have previously covered. Further, you may see some carriers not pull out of the Hawaii market, but rather temporarily decline to write any new business. So with that, Sean, I believe that's the end of my portion.
Thank you, Alex. Our next topic is essential to the AOAO community. The umbrella market is becoming very difficult to underwrite, and Kevin Pratt is here to explain. Kevin has been with Kevin Davis Insurance Services for over 10 years and is currently managing the umbrella market while also working as a senior underwriter. Kevin, please share your insights on what you see in the current umbrella market. Kevin, I believe you're on mute. There,
Hi.
you're good.
It wasn't allowing me to unmute for a while. Sorry about that. Thanks, Sean, and thanks to everyone at Atlas for inviting me to join you all today. So let's start with difficulties in the umbrella market. Over the past 6 to 8 months or so, the umbrella market's been going through some pretty drastic changes. Carriers are either changing their appetite or pulling out of the market altogether. And what that's done for insurers is that it basically made it harder to get umbrella coverage. Something that we've been experiencing and seeing across other markets is longer turnaround times to get quotes from those that are still in the market. This is a result of a couple of things. One is the influx of submissions from accounts that were non-renewed from other carriers. And the second has to do with tighter guidelines, which tends to require additional underwriting and review. One example of that is something as simple as parking space. If an association has some parking space available, in the past, it used to be enough just to have the square footage of that space and we would simply move on. Nowadays, we need to know what type of parking space it is, whether it's a parking lot versus a multi-level structure, or if it's underground parking. Also, you know, carriers tend to ask now whether it's open to the public or if there's someone there, you know, giving out tickets or charging for parking. So that's just one example of something that, you know, we're asking more questions about exposures. Also with COVID-19, carriers are starting to take an affirmative position in excluding communicable diseases. Our umbrella carrier is an example of one of those, but I do expect that other markets will follow suit if they haven't done so already. Next slide, please. Okay, so what's changing in the umbrella market regarding limits? Right now, what's going on, carriers are reacting and adapting to the hardening market. And so that is essentially so that they can try to ultimately remain stable and continue to write business. So they're doing that in a few different ways. The first is capacity limits, underwriting guidelines, non-renewals, and costs. With capacity limits, carriers they're reducing their limits basically, and oftentimes they're also writing those lower limits at a higher premium. This has to do a lot with their overall comfort level with the risk. In a hard market, carriers will look at something and say, we'll continue to write this class of business or this exposure, but only up to a certain limit. The second thing is underwriting guidelines. Every carrier has their box that fits within their guidelines, but in a hardening market, they tend to grow less comfortable with taking on risks with higher or unusual exposures. Sometimes they even shrink their quote unquote box with what they're willing to do. They do that, one of the ways they do that is by deciding to not write a class of business altogether. And this might be why some associations have noticed that they're getting declinations from some of these markets. Some examples of exposures that are a lot of times considered unacceptable are short-term rentals, seasonal dwellings, communities with assisted living, schools or student housing, buildings with helipads or underground parking. And as of recently, risks with multiple locations have also been considered unacceptable now, or unacceptable for their guidelines. The third part of this is non-renewals. This is also tied to the guidelines that we just talked about. From a renewal perspective, if carriers decide to stop writing a certain class of business, what they'll do is they'll go through their book, look at the accounts that they already write to see if any of those no longer fit within their appetite. And if that's the case, they unfortunately do not renew those. The last point here is cost. I touched a little bit on this earlier, but ultimately premiums are increasing for most carriers. It's pretty common in a hard market for this to happen. Associations can expect that for something that used to cost around $1,000 or $1,100 can probably be at least double that price, if not higher. Next slide, please. So what is the impact of the changing market on short-term rentals being viewed as hotels? Carriers are trending towards non-renewing these risks. The reason for that is they are very, very tough to write profitably. These umbrella programs were originally designed for traditional unit owner occupied associations. And that is pretty reflective in the price that's historically why premiums have been relatively low for HOAs and condo associations. But over the years, as these communities have evolved and with the growing popularity of rental programs such as Airbnb or VRBO, carriers are starting to view these communities more like public vacation type destinations as opposed to your traditional owner occupied condo. And by allowing these rental units within their community, associations are opening themselves up to exposures such as increased risk of bodily injury with more people coming in and out of the property. Discrimination is another one. Booking errors with the booking of that unit itself. And also ADA compliance is a pretty big one also. These exposures aren't always at the back of someone's mind. It doesn't always come up, but the exposures are still present, and even more so with rentals, with short-term rentals, I should say. And I believe that was my last slide, Sean.
Thank you, Kevin. Now that we are updated on the current market, let's turn to strategies to assist AOAOs. Today with us is our own Elaine Penalillo. Elaine is an account executive on the AOAO specialty team. She has over 14 years of industry experience, and she is a certified risk manager, a certified insurance counselor, and a certified insurance service representative. Elaine, tell us how you develop strategies with AOAO clients. Elaine, I think Elaine is muted right now.
Okay, thank you so much for the
There you
introduction,
go.
Sean, and
You're
good day,
welcome.
everyone. Today, I will be discussing best practices, tips, and strategies on how your community associations can get through the hard market. With the hardening insurance market, it is important to strategize with your insurance agent. Budget accordingly and as early as a year in advance. Work with your insurance agent on what type of premium increases your AOAO can expect. I'm sorry to be the bearer of bad news, but as we have heard from Jim Sipich earlier, insurance premiums will be going up, and we can foresee an average of at least 20% increases in premiums for those clients in the non-admitted or the excess and surplus markets. For clients in the admitted or standard markets, the increases may be a little bit lower based on their claims history. You will also want to have a discussion with your insurance agent on which insurance companies will be approached for quotes. Ron Sukamaki earlier gave us an overview on the underwriting appetites of the different insurance companies and what they are willing to insure. You have also heard earlier from Alex Montclair and Kevin Prack on how underwriting guidelines are getting stricter. With this, you'll want to partner with an agent who understands not only the insurance marketplace, but also an agent who takes the time to get to know your AOAO and your property so they can make the proper recommendation. You will also want an agent to help you explore other viable alternatives, including having access to all the available markets to keep the premiums affordable. Explore with your agent other viable alternatives to keeping premiums affordable, whether it's looking into higher deductibles or giving you a practical assessment of must-have coverages versus those that are nice to have if you have the budget for it. Next slide, please. Another best practice is to review on an annual basis the AOAO's insurable values and replacement costs. With property premiums rising, I know that some AOAOs may think that the way to save on premiums is by cutting down on building coverage limits. However, that is not really a possible option because of the following. Number one is the Hawaii Revised Statutes 514B, Section 143. It states that AOAOs need to obtain coverage in a total amount of not less than the full insurable replacement cost, including coverage for the increased cost of construction due to building code requirements. The second reason is that all of your AOAO's unit owners that have mortgages and loans will require annual proof of insurance for the entire association at full insurable replacement cost. The third reason is insurance companies' requirements. Basically, the insurance company wants to ensure that you have enough skin in the game. Most insurance companies use agreed value, but if they see that a client is underinsuring or underreporting values, they can implement coinsurance, and the coinsurance penalty will lessen the claim settlement that your AOAO receives. Rate credits are also only typically given to risks that are properly insured to value. Lastly, if an AOAO underreports their building values, in the event of a loss, there will not be adequate limits, and the board will be considered negligent. This opens up the board to a D&O claim, and while the D&O policy may provide defense, it will not pay for the settlement of a claim involving a board's failure to maintain adequate insurance. Next slide, please. Review the AOAO's losses and claims history with your insurance agent. For most insurance companies, a favorable loss ratio or claims ratio is 30% or less. This is calculated by taking the amount of losses, dividing it by the insurance premium, multiplied by 100. Simply speaking, if you have a premium of $30,000, you want your claims to be below $9,000, below 30%, to be considered a good risk by an insurance company. Second, you'll want to look at your claims frequency and how often you are submitting claims. If there is a frequency issue, the AOAO needs to look into more proactive measures in preventing these claims from reoccurring. Third, you want to review the severity of your claims or how big and expensive your losses are. Fourth, before renewing an account, underwriters also look at the loss ratio from the last 3 years, as well as the frequency and severity of the claims. Underwriters will want to know how and why the losses happened, and they want to uncover if there are maintenance issues and if these losses could have been prevented and what the AOAO is doing to prevent these claims from happening again. This is why you'll need an insurance agent who will be able to offer you practical and actionable loss control steps to prevent future claims from happening again. You'll also need an agent who will be your biggest advocate when representing you to the insurance companies. During my years of doing insurance, I have come across situations where we were able to successfully place an insurance policy on an AOAO that has a less than favorable loss history. This is because we took the time to tell the underwriter what the steps that AOAO is taking in order to prevent the losses from happening again. I often use the line, "Help me help you," when I talk to property managers and to boards. The reason why I'm asking all these questions about why and how the losses happened is that so we can find a way to prevent them in the future. Knowing what the underwriters are also looking for and the loss control methods that we recommend are the key to having an underwriter go from unsure to yes, we can write the policy, because we're able to convey that the AOAO is trying and that they're being proactive in preventing future losses. Next slide, please. Inspection and maintenance to maintain the AOAO's insurability. It's never a good idea to defer much needed maintenance. Deferring building maintenance is not the way to save money because it might end up costing you more. The analogy I like to use is it's the same as maintenance for your car. Deferring inspections or maintenance is like continuing to drive with your check engine light on. At that point, you're basically just gambling and hoping that nothing bad will happen. So what are the types of property maintenance that underwriters are looking for? First is we recommend high-risk components inspections to be done on common area elements and inside every single unit every 3 years. You remember those tougher underwriting guidelines? Property insurers like DB Insurance and First Insurance are now requiring condo water damage prevention checklists for renewals and new business. The high-risk components inspection is part of that checklist. Second, regular inspection and maintenance of vertical stacks or main plumbing lines and connections will be another way to prevent losses. Third, keep good records of updates to the roof, plumbing, and electrical. Underwriters will be asking about this. Be ready and be cooperative in giving us these answers so we can show your AOAO in the best light possible to the underwriters, thereby protecting your insurability and getting the best rates. Fourth, be prepared for inspections by the insurance companies. With stricter underwriting guidelines, inspections are now a requirement from property insurers who want to see that your AOAO is well maintained, and from liability insurers who want to make sure that there are no hazardous conditions on your property that could cause bodily injury or property damage. Next slide, please. Consider safety systems and have an emergency response plan. We recommend that AOAO staff and board members are properly trained on what to do during an emergency or a loss. A lot of these are common sense, but it's still worth mentioning so losses can be prevented and mitigated. For water emergencies, consider water leak detectors to prevent losses and also to prevent claim severity. AOAO staff will need to be trained on where water shut-off valves are and how to turn them off. The AOAO staff or property manager will need to instruct or help unit owners involved in a water loss to call the remediation company right away to prevent damage from spreading. With water damage, what we're trying to prevent is the growth of mold, because most insurance policies have mold sublimits on how much they will pay for treating or removing mold. For fire emergencies, insurers require safety systems like smoke detectors and fire extinguishers at the very least. Some insurers, like First Insurance Company and Fireman's Fund are also being more selective with new accounts, and they will not be insuring any AOAO high-rise buildings that do not have fire sprinklers if they're not already on that account. So to prevent severe fire losses, AOAO staff will need to be trained on where and how to safely use the fire extinguishers and how to properly respond to a fire or smoke alarm notification system. A practical fire evacuation plan will also need to be in place to make sure that lives are not put in danger. Call 911 as soon as practical and to call the remediation company as soon as the situation is stable to prevent damage from spreading. Next slide, please. Liability and D&O claim prevention. Earlier, we've heard Alex Montclair talk about the D&O policy renewal challenges. Due to the claims-made nature of D&O policies, it's that one policy that you do not want to see moved or non-renewed. A claims-made policy has a lot of time constraints. On a policy like this, the claim that's made against the AOAO directors and officers will be covered by the policy in place the time the suit or demand is served. For a claim to be covered, however, the occurrence or the incident that caused the suit will need to happen after the retroactive date, also known as the prior or pending litigation date. This is usually the policy inception date or the very first day when the policy was first written with that particular insurance company. The issue with being non-renewed and switching D&O insurers is that the AOAO potentially loses continuity of coverage for known past incidents. It is then very important to have board members who know and follow the rules, are professional, and understand the time and commitment it takes to serve on the board. Best practices include having annual board trainings on how to prevent liability and D&O claims, and also having board members sign an annual acknowledgement stating that they understand their governing documents, bylaws, and house rules, and they'll be making decisions fairly and in accordance to the rules. Thank you so much. Hope you were able to pick up some valuable strategies. Now back to you, Sean.
Thank you, Elaine. That was a thoughtful and thorough review of all the strategies to help AOAOs. Let's go over some key takeaways before we get into the question and answer portion. I will go through a few key takeaways from the presenters, and let's start off with the global markets. We want to expect a 10 to 20% increase as part of the sharing in losses globally. Also, Hawaii is relatively desirable for property insurance, which leads to healthy competition. And if non-renewed, E&S insurance will be an expensive option. From the D&O markets, we have limited options for Hawaii, and our markets are more selective, causing higher rates and deductibles and or non-renewals. The E&S marketplace is also expensive. Oh, excuse me, I'm sorry. I think I may be frozen. Can you hear me okay?
Yes.
Okay, great. For the D&O markets, I apologize. The rates will rise due to COVID-19, social inflation, and increased challenges for the boards. We'll be seeing a rate increase throughout the nation. And also the D&O carriers may not pull out of Hawaii because, but rather decline to write new business. For the umbrella policy, umbrella markets has capacity limits, and those limits are reducing due to the hardening markets. The underwriting guidelines for these are staying in the box. Non-renewed accounts will have unusual exposures, and there are cost increases for most carriers. And finally, the strategies to mitigate the hard market. Strategize early with your insurance agency. Have a good emergency maintenance plan, and also be proactive in avoiding losses and claims to protect the AOA's insurability. And finally, educate and train staff and board members. Okay, great. Let's open it now to all of our guests, and we're gonna move on to the Q&A portion. Okay, we have a couple questions for renewable related questions. Let's start with Ron and Elaine. What can I do to improve my chances of being renewed with my existing carrier?
Well, I guess that's an assumption that you might not be renewed by your existing carrier. But I think part of the issue is that underwriters are much more selective, as we've all talked about. And so how do you differentiate yourself as a risk to the underwriters? And what are they looking for? They're going to look at the carrier, at the clients or the associations that are taking that step in terms of loss mitigation, loss control, proper maintenance, a little thing like proper values. All the carriers are looking at values on a cost per square foot basis. Now, if you come in with a very low cost per square foot basis, what does that tell an underwriter? You're trying to be cheap on them and you're not being forthright. So, you know, that's why we really carefully review values with underwriters to show that the client is trying to have full replacement cost values to the best of their ability. None of us are appraisers, but we certainly look at cost per square foot, and we have a pretty good idea of what a typical cost per square foot would be for different types of instructions. Anyway, so from a property casualty standpoint, it's really that extra differentiation. It's the ability to for your agent to really give the best possible picture of what kind of risk you are.
Thank you, Ron. Let's also go on another question with renewable related. Elaine P. Should an association seek options from a different agent or go out to bid on their insurance?
Okay, for that, I would say that you should look for another agent if you have service issues with your incumbent agent. Ron Sukamaki earlier talked about this, and you can count on one hand the insurance companies that write Hawaii AOAOs in the property market. Because of this, agents will bump into each other in the marketplace, and the insurance company will only quote one agent, and it's typically the first agent to submit the application. So I think that an association will want to go with an agent who has access to all the admitted Hawaii insurers. I think the question more is really for AOAOs, they need to be asking themselves, is my association with the best insurance company in terms of pricing, coverage, and market availability? And has my agent approached, or are they appointed with all of the 3 admitted insurers in Hawaii, which are First Insurance, Allianz, and DB Insurance?
Thank you, Elaine. Let's turn a little bit to the D&O related questions. Alex, can board members be sued personally?
Yeah, good question, Sean. We get that all the time. And the answer is yes, and we would defend them as long as they were acting in capacity as a board member.
Okay, great.
I just want to add to that a little bit. Sorry.
Sure.
I would also, Alex is absolutely right, but I would just caution to always check your policy to make sure of that. And that there are a couple carriers out there that only provide entity coverage. So we always recommend to actually check through the policy.
Good point.
Okay, great. Another question I have is, if the majority board members blatantly disregard judicial safety codes, will the D&O cover the board members if a lawsuit arises?
It's a good question. So yes, but keep in mind, we have a duty to defend, but not if there's a BI or PD cause. Also, we may not pay for damages if the court finds the individual did something illegal, but we will defend until adjudication.
Okay, thank you. Another question on D&O related is, rogue boards cost their associations much in legal fees, and D&O does not always cover those fees. What can be done to help?
That's an excellent question. So I actually have some notes on that. So good question. In my opinion, a rogue board is a group of 5 people who don't obey the rules, i.e. a board who goes out to exuberant lunch every week and expenses it to the association, or a board who all of a sudden decides you want to paint all their lawns green or excuse me, purple or something like that. Go back to the D&O coverage. It's meant to cover a wrongful act. So most of the time, the rogue board's actions will be covered. However, there are times when your board is explicitly doing things that are outside of this coverage. For instance, as mentioned in my presentation, something bodily injury or property damage related. If you're currently going through this situation, make sure you have your carrier on notice and just get through it the best you can. Preemptively, however, before this happens, practice Robert's Rules of Order on how to control a meeting and make sure you're explicit in what every member of the board's role is and are properly following the procedures. Make sure you have a great agent such as Atlas and a great property manager. And as always, hire a good attorney who specializes in associations. Meet with them regularly to discuss any concerns.
Thank you. Let's go to a value-related question. Ron, is reducing my AOAO statement of values a viable strategy to reduce my premiums?
Well, the short answer is certainly not. As I mentioned, underinsuring, well, first of all, Elaine mentioned various reasons not to underinsure. First, it's a statute requirement to take full replacement costs as best as you know. There's certainly, if you have inadequate limits, you could have a shortage in the event of a major loss. And so shorting values is not the way to get cheaper premiums. We've actually had clients come back to us and say, could we use 80% of the values? And the answer is no, because you're sending a signal to the property underwriters that you are trying to underinsure. And that just isn't a very good signal, because so are they willing to give you all the rate credits? No. So when the day is done, you really hurt yourself.
Thanks, Ron. Here's another question for Ron, for you, and possibly even Jim. Do property appraisals for accurate replacement cost and COPE data collection have any significant impact with any of the carriers you discussed? And how does accurate replacement cost values and comprehensive COPE data affect premiums at renewal?
Well, I'm going to start. I'll let Jim fill in, especially because values are important, also in the E&S market, heavily important. But for the local marketplace, they regularly look at cost per square foot. And not having adequate limits is certainly a reflection, I guess, on the client. So having a good appraisal gives comfort to the underwriter that the association is doing everything possible to have adequate coverage and adequate limits. So they're not trying to short the insurance carrier out of premium just because of lower values. So that is important, and I think it shows quality or that extra step that we're trying to differentiate our clients to the underwriters. Jim, you got?
Yeah, well, I think we've covered the replacement cost values pretty well. All those are valid points. I guess I would further add that our experience here following catastrophes like the Northern California wildfires is demand surge in materials and long delays in finding contractors and getting work done. Those drive up costs dramatically, and a lot of people were dramatically underinsured here as a result of those things. So not only, I think the bare minimum is doing good appraisals. That's, at least you know that much. You don't know what's the unknowns of what it might cost in the long run. And then again, to both Elaine's and Ron's points, in this market, the scrutiny that we're seeing from underwriters, it's really important to have good quality COPE information, construction, occupancy protection, exposure, and the best possible submission, because it's easy just for underwriters to say no in this market.
Okay, thank you both, Ron and Jim. Elaine, we have a question for you. What are some of the things to consider when seeking another agent or agencies involved in a renewal?
Okay, thank you, Sean. So with this, I think that the important things to look for is that you'll want an agent who will be your biggest advocate when representing you to the insurance companies. You'll want to seek an agent that also has access to all the relevant and available insurance companies. Like what I've mentioned earlier, the 3 admitted markets: First Insurance, Allianz, and DB Insurance. Not all agents or agencies have access to all 3 markets. Fortunately, Atlas has access to all those 3 markets, as well as the non-admitted or the surplus and excess markets that we look at as the markets of last resort. You'll also want an agent who will act as your business partner in guiding you with practical and actionable tips on how you can prevent or manage losses. So an example I've said earlier is the high risk components inspections being a part of renewal submissions now, and even new business. You know, we see a lot of claims coming from water heater supply lines rusting and leaking into the units beside and below them. If you can imagine, your water heaters in your units typically hold 50 gallons of water. That causes a lot of damage. By having the high risk components inspection, water damage resulting from these rusted or corroded water heater supply lines can be caught and replaced before they start leaking. So with a high risk components inspection, you'll want a licensed plumber every 3 years who will check on the following: all the water supply and shutoff valves within the units, all waste toilet seals within the units, all appliance hoses and water supply lines to these appliances, and all faucets, toilets, tub, shower, head systems, and water heaters within the units. That's it for me, Sean.
Thank you, Elaine. And I have one more question for Alex. A VP director willfully fails fiduciary duty by failing to abide the CCRs. The majority board members overlook the violation. If a lawsuit arises, does the D&O support these board members and cover the majority of board members who made the bad decision? Alex? I think you're on mute, Alex.
I'm sorry about that. I wasn't able to unmute myself there for a second.
Okay.
It was a great question. And yes, we still have the duty to defend. I don't know if Kevin or anybody else has anything to add there, but my short answer is yes, we would.
Yep,
Okay.
that's it.
Okay. Let's see here. What else we have? We have Ron. We have one question for you. I've been told my insurance carrier is an alien insurance company. Does it matter?
Well, let me explain what Alien is really quickly. Alien is a company that is not from a US-based company. So Lloyd's of London is an alien company. Certainly, one big carrier here is Tokyo Fire Marine. They own First Insurance. Well, Tokyo Fire Marine is based out of Japan, so they are an alien company. It's just a designation to tell people in insurance that they're not from the US. They're from a foreign country. They use alien, but maybe they could say a foreign. But so it is not necessarily bad.
Okay, great. I just another question is, what about the percentage? What percentage higher insurance do you have if 75% of your owners operate short-term rentals? Ron, we'll go to you.
Well, first of all, that's really falls in the area of umbrella, I think, with Kevin,
Yeah,
and
okay.
certainly also could impact Alex from a property carrier. we're interested in the physical structure. So the issue of a lot of short-term rentals usually doesn't impact the property carriers significantly, but certainly it does impact the liability carriers and the umbrella carriers and the D&O carriers. So I'll turn this over to Kevin.
Right. Thanks, Ryan. So yeah, with a high percentage of short-term rentals like this, with 75% of the owners renting them out short term, for our program, is actually ineligible for the umbrella. We don't write any kind of short-term rentals at all. The markets that do write them, I would imagine that the pricing is going to be pretty significantly higher than normal. It might have to go to surplus lines also, because we are seeing more and more policies and carriers step back from that and not write those.
Okay, thank you. Okay, that wraps up our question and answer portion of this. And you know, you may be asking yourself, okay, what can we do to prepare for the hard markets now? Well, the first step is getting, you know, we can offer a free comprehensive review from our AOAO team. We can also provide our audience today with a high-risk component checklist. And this will be helpful in managing your AOAOs. Brandon Keenan, our business development manager, will be sending that out later on today. And right now, I just want to thank our audience for participating in today's webinar. And on behalf of Island Insurance Agency, I also want to thank all our speakers on their insightful views and their expertise. Jim Sipich from CRC Insurance, Alex Montclair and Kevin Pratt from Kevin Davis Insurance Services, and our own Ron Tsukamaki and Elaine Panlilio of Atlas Insurance. If we did not get your questions or you have additional questions, please, we have included the contact information below. You can contact one of us, myself, or Brandon. Thank you for attending our webinar today, and we appreciate your time and your busy day. Take care and mahalo. Thank you.